Hey everyone, my name is Jack, and in this video I want to go over a common mistake that many first-time homeowners make when they end up buying their first property. Buying a home for the first time is often the largest financial decision that person has made up to that point, unless that person went to just about any undergraduate university in the US nowadays. And homeownership is often a very good thing. It has the potential to allow someone to advance economically, especially over the long haul. It's not automatically a bad thing. That is, as long as the person who buys the home doesn't make a very critical mistake. But before we get into that, let's make sure we understand the advantages of homeownership and how it can help someone to advance economically. Unlike with renting, homeowners get to build equity in their property as they pay down their mortgages over time each month. At the same time, they can benefit from any appreciation that their home receives over time if the market is doing well or if they make improvements to the property. Even though equity in your home is often a rather illiquid asset in that you can't easily turn it into cash, it often takes a lot of time to do that, you can still do it with something like a home equity line of credit or a home equity loan, and of course you can always theoretically sell the home if you need to get that cash. But these things do take a lot more time than just, say, selling a share of stock on the open market. Owning your home can also let you tap into bigger benefits like house hacking, where you can actually turn your home into an income-producing asset, which is something that I do with my current home. Basically, you buy a place that's a little bit too big for yourself, maybe it has extra rooms, or if you buy a duplex or a triplex and you live in one unit, you rent out the remaining space to then offset the cost of your housing. This can allow you to build wealth even quicker as opposed to just fronting the mortgage with your own income each month. Instead, you have extra rental income coming in from your home rather than, say, standalone rental properties. And this is especially advantageous for homeowners since they get to take advantage of some of the best financing available for any asset class in any industry. Typically, homeowners and prospective homeowners can get access to 30-year fixed-rate mortgages at some extremely low interest rates, depending on what program you use. And in our current market, where you can often get 30-year fixed-rate mortgages for less than 4% annually if you have a good credit score, when you couple this with the tax advantages of real estate and consider the fact that inflation will eat away at some of these interest costs, it's no surprise that a lot of people will call this something like free money. But it's not quite that simple, since even though you might be gaining equity each month, you still have to meet those monthly payments every single month. What this means is that cheap financing, while very advantageous for many people when used properly, if you take too much of it, it can be very dangerous as well and hamstring you financially. When super cheap debt is available to so many people, it's often easy to take off more than you can chew, even if you get approved for it at the bank because you meet the lender's requirements. But just because you meet the requirements at the bank does not mean that you should necessarily take out the maximum loan that you are allowed. As is often the case for people when they buy their home, they're not using it as an income-producing asset. They have to meet that debt through their own personal income or income from other sources. And this can fluctuate depending on what industry the person's in or how stable their job might be. And because they don't have rental income coming in on this particular property since they're living in it, if they're not doing something like a house hack, this means that they have to be able to meet those payments each month no matter what happens. And if they don't leave themselves enough room, even though they got approved for that mortgage in the first place, it doesn't matter because they're not going to look at your approval when they send you to foreclosure. If you don't have other major debts, banks will often approve up to 45% of your income to be used just towards your mortgage payment and taxes for whatever house you might be looking to buy. This means that 45% of your income, as it currently stands, will be committed just towards your house. That is a huge financial drain for someone if you're trying to invest in other things. And because it's fixed financing, that payment is going to stay the same until you refinance out of it or until you completely pay it off, which obviously will take a lot of time if it's the maximum mortgage that you can possibly afford. The best strategy when you're buying a home, especially when you're using debt, is to simply take something below your means. Maybe a lender is telling you that you can afford a $500,000 house, when in fact a $300,000 house would suffice for your living standards, and even a $200,000 house if you can find one in your area, or even less depending on what area of the country you're in. This will translate in thousands in savings that can be used to invest in other things besides the equity in your home. Because after all, like I mentioned before, the only real way to get the equity out of your home is to sell it, and then you're going to have to move out anyways, or you can take out another loan, which can get messy since you're risking your home for that debt. Not to mention, when you first start a 30-year amortized fixed rate mortgage, your first few years of payments are almost entirely going to be going towards interest rather than equity. So if you end up wanting to tap into that equity within a couple of years, you're probably not going to have much in there unless the market appreciates a tremendous amount or you make huge improvements to the property. Another strategy to consider when you're buying your home is to look at it from a rental perspective. How would this property function as a rental property if it came down to it and you wanted to move out, and then you could hold on to this property and use it as a rental? If you're not sure how to calculate rental property metrics, as always, I've included a link in the description for a free rental property calculation spreadsheet. All you have to do is plug in the property numbers and you'll be able to easily see if a property would work as a rental. If you're comfortable with rental metrics already, you can always change the spreadsheet and add to it, also free of charge. When you look at it from this perspective, rather than just looking at what you can potentially afford with your own income, you'll look at it from an investor's perspective. What will market rents justify for the price for this building? And that will help you to make sure that you're getting a deal that's more feasible over the long haul, especially if you need to stay flexible in where you're moving. In short, your home should not be what hamstrings you from achieving your other financial goals. Obviously, buying a home is a significant financial achievement that can have many huge benefits over the long term, but you have to be careful that it doesn't hamstring you from going out and achieving other things in the meantime. If possible, your home really shouldn't be your primary investment plan, because again, if you need to get that money, you're going to have to sell your home and find some other place to live, which can be very stressful and often can take a long time to actually sell the home in the first place. That's not something you want to really be relying on, especially as you get to retirement age or towards the end of your career. If you end up buying a home, give yourself some flexibility by buying a property below your means, and ideally that would also function as a rental if it came down to it. If you're unsure about a certain strategy, be sure to consult with a licensed financial professional so that you can figure out a strategy that is best for your needs and your circumstances in your life. Whatever stage you're at in the home buying process, I hope you found this video helpful, and if you did, I hope you give it a like. I post new videos every single week, so be sure to subscribe so you don't miss any of those. Until next time, take care.